Hey everyone, and welcome to The Explainer. Today, we're diving into one of the biggest promises in finance, putting real-world assets, like stocks, right onto the blockchain. Now, the vision here is incredible, making investing instant, way cheaper, and open to literally anyone on the planet. But, as we're about to see, the way we're trying to build it right now is, well, it's kind of broken, and it might even be putting investors at risk.
So what if I told you the solution isn't some brand new, super complex piece of code? What if it's a trusted financial tool that's basically been hiding in plain sight for over a century? Let's get into it, because the answer is actually pretty fascinating.
All right, so before we get into all the problems, let's talk about the dream. Why is the entire financial world so obsessed with this idea of tokenizing stocks? Well, it turns out the potential upside here is just massive. I mean, the vision is for a financial world that actually works for you, one that's faster, more open, and way more efficient. Just imagine your stock trades clearing instantly, not in a couple of days. Imagine being able to invest in companies all over the world just as easily as you order a pizza. And this term, programmability, that just means we can unlock a whole new universe of automated financial tools. So yeah, this isn't just a small upgrade. We're talking about a total transformation of how markets work.
And this is a big but. As exciting as that future sounds, the way we're trying to build it today has some really serious cracks in the foundation. The reality just isn't living up to the promise. Not yet, anyway.
So right now, the two main ways people are trying to do this are creating systems that are, honestly, fragmented, confusing, and here's the most important part. They often lack the basic investor protections that we've all relied on for generations. This isn't just some small bug in the system, it's a fundamental flaw that's holding this whole amazing idea back.
Okay, let's break down these two flawed approaches. On one side, you've got the wrapper model. Think of this as a tokenized IOU. Some company buys a share of Apple, and then they issue a token that says it represents that share. The biggest problem? You can see it right there. You get no direct ownership, no voting rights. You don't really own the stock. Then your money is siloed, trapped in just one ecosystem. And to top it off, the rules around it are often murky. On the other side, you've got on-chain issuance. Now this sounds better. It's a native digital share, but it's an operational nightmare. It's super hard to scale, it splits the market into two different pools of liquidity, and it actually requires the company, like Apple itself, to actively get involved, which is a huge ask. So you're stuck with two bad choices, one that isn't real ownership, and another that just isn't practical.
So, if the current ways of doing things aren't working, what's the answer? Well, this is where our story takes a really interesting turn. We're going to look back into the past to find a model for the future.
What we really need is a structure that gives us that instant, global, accessible nature of tokens, but with the legal clarity and the investor safeguards of the financial system we already have. And what's cool is that model already exists. So I want you to meet the depository receipt, or DR. For over 100 years, this is how investors in, say, the US have been able to easily buy shares in foreign companies. It's simple. A bank holds the actual foreign shares, and then it issues a certificate, a receipt, that can trade on a US exchange. It's basically a bridge between two different markets.
And this quote right here, it just perfectly captures the idea. A depository receipt is essentially an analog token. It's a tradable thing that represents and is fully backed by another asset that's held securely somewhere else. Sound familiar? Of course it does. It's the exact same concept we're trying to build on the blockchain today.
So, why is this 100-year-old structure so perfectly suited for our modern digital problem? Well, as we're about to see, it pretty much elegantly solves every single issue we just talked about. The DR framework brings 5 key advantages to the table that completely solve the problems we saw with the other models. We're talking real shareholder rights, asset safety, a clear regulatory path, true one-to-one value, and it's built to scale from day one. Let's dig into each of these. Okay, first and foremost, and this is a big one. Unlike that wrapper model, a DR-based token gives you real shareholder rights. You get the dividends, you get to vote in company meetings. You're not just holding some synthetic IOU, you have a direct, legally enforceable claim on the actual share. It's the real deal. Next up, and this is all about safety. With a DR, The actual shares are held by a trusted, regulated bank, completely separate from the company that's issuing the token. This is what bankruptcy remote means. It's a fancy way of saying if the token issuer goes bust, your assets are still safe and sound, held there for your benefit. It's a level of security that many of the current crypto models are sorely lacking.
And hey, this isn't just some wild theory. There's a strong regulatory precedent for this. Even Hester Pierce, a commissioner at the SEC, has pointed out that this idea, a token acting as a receipt for a security, is a clear and understandable path forward. The regulators get it.
Now, this next point is absolutely crucial. Fungibility. That's a simple idea. It just means your tokenized receipt can be seamlessly exchanged for the underlying share and vice versa, always at a one-to-one value. And we know this works. Decades of data on American depository receipts, or ADRs, proves it. They trade in perfect lockstep with their shares in their home market. This prevents those weird price gaps and ensures one fair, deep, liquid market for everyone.
So, this brings us to the final takeaway. How do we move forward and finally realize the true promise of tokenized stocks?
You know, the answer isn't to keep trying to build these complex, flawed systems from scratch. The most powerful innovation here is actually to adapt a structure that is already proven, that's already trusted, and that's already fully integrated into global finance. We just need to apply it to our new digital rails. And really, that's the bottom line. Building the future of finance doesn't always mean you have to burn everything down. Sometimes it just means recognizing the strength of the bridges we've already built. The only question left is, who's going to have the vision to cross them first? Thanks for watching The Explainer.